Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for the final time this week. It's Friday the 2nd of February. We're looking forward to the weekend, but first we've got some business and finance headlines to discuss. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance stories, the Hong Kong Monetary Authority kept its base rate steady at 5.75%. Hours after the US Federal Reserve left the Fed funds rate unchanged at a 23-year high of 5.25% to 5.5%. and signalled that it wasn't yet ready to start cutting rates in March. Commercial banks in Hong Kong kept their prime rates unchanged in line with the HKMA's decision. The Bank of England has signalled for the first time that it's ready to consider cutting interest rates, even as it cautioned that it's not prepared to start easing them yet. By a majority of 6-3, the Bank of England's Monetary Policy Committee voted to maintain the bank's key rate at 5.25%, as widely expected. BOE Governor Andrew Bailey said the bank had seen good news on inflation over the past few months, and the central bank would keep under review how long rates should be held at current levels. But he stressed the central bank would need more data before it started reducing rates. Official trade data from South Korea showed robust growth in exports, thanks in part to strong demand for the country's semiconductors. January exports jumped 18% from the previous year versus 5% in December. Rising semiconductor exports and shipments to China helped drive growth. Chip exports surged 56.2%. That's the biggest rise in 6 years. Shipments to China jumped over 16%, ending a 19-month decline. India announced on Wednesday one of its biggest ever increases in capital spending for the next fiscal year to create jobs. Narendra Modi's government said it would raise spending on railways, airports and other infrastructure to a new high as it unveiled its final budget before the election. Finance Minister Nirmala Sitharaman said in her budget speech that New Delhi would spend $134 billion in the coming fiscal year, in a move she said would have a large multiplier impact on growth and investment. She described India as a bright star, with this year's economic growth estimated at 7%, despite the global economic slowdown. On today's programme, I'm joined by Francis Lun, the CEO of Securities, and Kenny Wen, Head of Investment Strategy at KGI Asia. With a view from Australia is Toby Lawson, the CEO of Statton Partners. And if you want to get in touch, please go to my website and post any questions or comments at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks closed higher on Thursday, rebounding from a sell-off in the previous session after Federal Reserve Chair Jerome Powell pushed back against hopes that interest rates could start to fall as early as March. Earnings returned to the forefront, with three of the so-called Magnificent Seven, Apple, Amazon and Meta, reporting results after the market closed. The S&P 500 added 1.3% to 4,906. The Dow climbed 370 points, or 1% to 38,520. The Nasdaq Composite gained 1.3% to finish the session at 15,362. Treasury yields fell after rising jobless claims and more bank sell-offs, which was partly counteracted by a strong ISM manufacturing report. The 10-year yield hit its lowest level in a month before reversing modestly to end the session 6 basis points lower at 3.87%. The dollar index ended the day 0.5% lower at just above 103. Gold climbed for a fourth straight session, settling 0.7% higher at $2,054 an ounce. Oil fell after news reports from Al Jazeera that an Israel-Hamas ceasefire is imminent. Al Jazeera later deleted the original report. However, oil failed to recover from the initial sell-off, settling 2.3% lower at $78.70 a barrel. And Hong Kong shares closed higher after the Caixin China General Manufacturing PMI released Thursday showed factory activity in the world's second largest economy expanded for a third straight month in January. The Hang Seng Index closed 81 points higher, that's 1/3% at 15,566. The Tech Index rebounded 2%. China's CSI 300 rose under 0.1% to 3,218, rebounding from near 5-year lows, and the Shanghai Composite was down 0.6% at 2,771. Looks like Hong Kong markets are going to continue their rebound. Futures pointing to a gain of about 60 points for the Hang Seng at the open. Looks like the index is going to open around about 15,625. And you can get more details on all those latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Well, January went in a flash. We're already the first February, the first Friday in February. That means it's time to welcome Francis Lund, the CEO of Securities. Morning, Francis.
Hi, good morning.
And also with us is Kenny Wen, who's head of investment strategy at KGI Asia. Morning to you, Kenny, as well.
Good morning.
Well, what a month it's been for Hong Kong and Chinese stocks. We did get a bit of a rebound yesterday, as you heard there. The Hang Seng closed about 1/3% higher. The tech index rebounded 2%, and the CSI 300 on the mainland was just clawed into positive territory, rising under 0.1%. But what about January? The Hang Seng was down 9.2%. That's the worst start to a year since 2016. It's also the worst monthly performance since February 2023, and it also was the worst performer among all the major equity benchmarks worldwide in January. Losses were widespread across all sectors. The tech index tumbled over 20% in January, and the CSI 300 index and the Shanghai Composite both lost 6.3% last month. Francis, despite all the stabilisation measures that have been announced, markets are still falling. Why is that?
Well, I think you have to point to one thing. A key factor is that the Chinese economy basically, it did not stop growing, but it has been growing at an anemic pace. You can see it from the PMI index, and we were celebrating when the PMI came in at 50.2, which is barely up.
Yep.
And then yesterday, actually, the official PMI came in at 49.2, showing that for state-owned enterprises, the factories are still not operating fully. I think it has been a long and painful recovery, and to top it off, it's really the decline in the property market. And Evergrande was granted the bankruptcy petition and is in the process of winding up. Chances are nobody will get anything. It's only an empty shell now, because what can be so have been so. I think that what is left will be taken over by the government, and everybody expecting this bombshell to really to peter out. But then other bombs are keep coming, like Country Garden and Kaiser and Vent. And I think 2024 will be we will hit bottom. But when is the bottom? I really cannot tell. But maybe in the middle of the year.
Kenny, I mean, all these things that Francis lists have been known about for a while, haven't they? So isn't this a bit of an overreaction, do you think? Because there's no surprise in Evergrande. We've known about the property sector. Yes, the economy is not doing great, but it is still growing. But yet this has just been almost month after month after month of declines for both Hong Kong and Chinese stocks.
I don't think it is overreacted, because the market was driven by some structural issue that is concerned of, just like mentioned by Francis. The investors still concerned about China economy and the property sector. We worry over them in 2023. We still worry about them in 2024. This type of concern will not suddenly disappear. Right, so we're still driven by those factors, and I think another issue is the policy support. Some investor, including myself, will believe that is not sufficient, because if you focus on Hang Seng Index, it dropped below 15,000 in 22nd of January. That is the day which the central bank to keep the interest rate unchanged. And then there's news regarding the 2 trillion RMB stable fund and cutting the triple R. You see, actually, the stock market rebounded from below 15,000 to now around 15,500. So I think given we don't have enough confidence on economy, we still waiting for a more powerful policy to support our support the economy and also the stock market. So I think it's one of the key issues. And then during the period, I think people also worry about the China-U.S. relations, because you can see that there's many news saying that U.S. may have another round of sanctions on life science stocks or some Lenovo, some IT stock as well. So it's really quite a lot of bad news. But on the other hand, excluding the P/E ratio is very cheap, I don't see any good news coming from the Hong Kong and China market. So that's why the Hong Kong market is still under pressure. I think it's driven by many structural issues.
Those structural issues you mentioned, though, are going to take a long time to resolve. We're talking years, aren't we? Not just months. So does this mean that the Hong Kong and Shanghai markets, they're just going to grind lower, or even if they don't go lower, they're not going to rebound from here?
I have two scenarios. The first one here is if we have some kind of financial crisis, then of course the Hang Seng Index will have a lot of the downside risk. But on the other hand, if we don't have the what we call financial crisis, then I think the downside risk will be relatively limited. 1,000 or 1,500. But on the other hand, those structural issue mentioned by me, I will say is limited the upside potential for Hong Kong stock, because you're right. For the China economy, we don't have the property leverage now. We don't have the labor advantage now. So it's really difficult to have a 6-7% GDP growth. And also, I think the position of Hong Kong is totally changed because in the good days, we in the middle of China and US, we can take the advantage. But now we are suffering their disagreement. And the third issue is, I strongly believe in 2024 or 2025, AI or technology will be a very important investment theme. But in Hong Kong, most stocks are related to financial, property. We actually don't have much AI stocks. So this structural issue, I don't think can be solved within weeks or months.
I mean, Francis, if we look at where the Hang Seng is now, it dropped below the level back in 1997 when at the time of the handover. So, basically your clients have made no money since then. How are clients, Francis, reacting to all of this? Because it must be pretty despairing for them to just see this going on month after month.
Yeah, that's right. Actually, I advise my clients to switch to U.S. stocks already. If you had you bought the cheap stocks like Nvidia and AMD, you would have make a lot of money already. So to play the Hong Kong market, you can still buy the derivative like 7,500, which is 3 times the Hang Seng Index down. So you can short the market, or you can buy U.S. stocks, and of course you can also buy Japanese or Indian stocks, and then you will come out ahead.
So I think there's one key point is, sorry to add in, I think one key point is, yes, Hong Kong or China stock market performed disappointed. But other than that, in US, in Taiwan, the stock market performance were quite good. So if investors globally invested, including US or Taiwan. We are relatively positive on Taiwan this year because, as I mentioned, we like AI theme, and we think the AI theme will change from software to hardware. So the Taiwan market will be the beneficiary, and then we can focus on stock. We can focus on fixed income as well. So if you really allocate your capital into different asset classes, also different countries, actually 2023 your performance was not that indeed.
I mean, we see that, don't we, in the mandatory provident fund? If you're in a global fund and you're well diversified and you try and get away from this home bias of, investors preferring their home market, you would have done pretty well because even though China and Hong Kong's down, there's the US, there's, as you say, Taiwan, Japan, India. Even if you just had an Asian fund, you would have done quite well last year.
Yeah, exactly.
I mean, Francis, is there a difference between how international investors are seeing the markets here as opposed to local investors, or is everyone just dumping shares?
Well, actually, local investors are much more loyal. Most of them, especially the elderly ones, they have been invested in this market for ages, for decades. So it's difficult for them to change the habit and then switch buying U.S. stocks. And up until maybe last year, I don't think that many Hong Kong investors buy into U.S. stocks. It's only ever since last year that actually the young investors, especially those in the 20s and 30s, started buying U.S. stocks, and also because some of the brokers offer very good services. So buying U.S. stocks is much easier, except that you have to wake up in the middle of the night. So that's why more people are buying U.S. stocks now, and then actually the problem is the Hong Kong market is very dead, and most of the stockbrokers who do is Hong Kong market only, really suffer.
A lot of the issue as well is also the perception, isn't it, of the local market by investors. So how do things like the introduction of a new security law affect that? Does that worry investors at all, or does that worry companies and businesses, or are they not concerned?
I don't think it's the law that affect the market. It's really the listed companies fail to grow. I think up until 2021, or I think somewhere around there, the big techs like Alibaba, Tencent, Meituan, etc., they've been growing like 30% a year. But ever since 2021 or 22, they stopped growing. And then with that, the share price started to fall. And not just fall by 10 or 20%, but fell by 70% or more. So that really killed the market. I think everybody's lost big money. And unless the exchange fund help us spend $200 billion.
Surely not again.
I think we can recover from this slump.
I mean, Kenny, what do you think here? How much is the perception of Hong Kong changed? Is Hong Kong still perceived by investors and by businesses, by companies as a good place to do business, or has that been damaged by the things that are going on and also the introduction of national security laws?
I think whether Hong Kong is still worth to doing business is another issue, but I want to focus on the inception or the mentality of the foreign investors. I mean, 10 years ago, for a US investor, maybe they're holding 100% US stock. and then they found that China GDP growth is talking about 6%, 7%, 8%, maybe, and also he heard about Tencent, Alibaba perform quite good. So he would like to diversify some of his portfolio for diversification, right? But after 5 or 8 years, they finally know that it is not diversification. It's actually hurting their portfolio performance. So the inception is totally changed. Why don't I focus on US stock, which they know much more better than China stock? And the performance is much, much better. So I think the inception is totally changed. But whether the security law will hurt the Hong Kong as a financial center, I don't think so. But at least for short term, there's not the key issue or the major issue which affect the investor views. I think it's the performance of the stock market.
Do you worry about things, though, in the law that maybe could criminalise things like the providing of economic information? I mean, economic information could be a state secret. So if you're a broker and you write reports about the economy in Hong Kong, are you divulging state secrets now? Is that a concern?
I'm not really concerned because I'm a investment commentator. I comment on stock market, China, global economy every day. But I think if I follow the law, make a fair comments based on facts, I'm not too worried about that.
Francis, what are your thoughts?
Well, I think the national security law is really too broad. It really depends on how you apply it. I think for most commentators, they use published information to write comments. So that should not be seen as a breach of national security law. I think it's really the way they applied it. If you apply it like on mainland China, anything can be national security. But of course, in Hong Kong, we don't see that commentating on the economy can be a breach of national security. I think people maybe worry too much. I
mean, but that's the fear, isn't it? That this is becoming more and more like mainland China and their definition of national security and state secrets and spreading rumours and false information, that we're going to become more and more like the mainland.
Yeah, that is the problem. That's really how you applied it. If you can have an objective way of an objective standard, that may be better. But if you have a subjective standard, you can say anything is national security.
Yeah, I agree. So we can wait and see how the court to apply those laws.
How do interest rates fit into the picture? Obviously, we're not going to get an interest rate cut now in March, as investors had been hoping for, certainly according to Jerome Powell anyway, earlier this week. However, interest rates are interest rate cuts do appear to be on the table. Both the Bank of England and the Fed have said they're looking at that. Will that help the markets here if we start seeing interest rates being cut?
Yeah, definitely. I think that will ease the pressure on the renminbi because last year, one of the reasons that the China market went down was because the weakness of the renminbi is 7.2 or something like that. And I think now it's 7.1. So I think if the U.S. Starts to cut interest rates maybe in June, I think we can expect a rebound in the equity markets in China and Hong Kong. I think at least for Hong Kong, that the interbank rate will fall a little bit. And right now it's something like 4%, which is really, for the past 10 years, which is a very high rate already.
Yeah, I agree that if cutting rate in US will be positive on Hong Kong economy as well as Hang Seng Index, but I will treat it as bonus. I think the fundamental issue still around the China economy and property sector. If those structural issues did not solved, even though Hang Seng Index driven by the interest rate cut and then go up 1,000, 2,000 points, it will drop back again. And I agree with Francis. Our house rule is the FOMC will cut interest rate in May or June, because if you refer to the post-meeting statement, seems that the official needs greater confidence to conclude that the inflation has slowed it sustainably. So they still need waiting for 1, 2, 3, or 4 months data to confirm their views.
It's interesting, isn't it? Because it's not just the Fed that said that. The Bank of England said the same thing yesterday as well, that, they want to see more evidence that inflation is going to hit this 2% target and stay there. But I'm wondering, what do they need to see to convince themselves of that? Because I can see things going on around the world that actually could push inflation back up again. We have these various disruptions going on in the Red Sea and other parts of the world. Yeah. So what is it that's going to convince them, do you think, that inflation is now under control?
I think I'm sorry. I think that is right. That's a conflict between the U.S., maybe Iran-backed terrorists or IS, and the U.S. is going to retaliate today or tomorrow. And we hope that the conflict will not go out of hand, and if that's the case, and there will be more disruption in the Red Sea, and that may drive up freight rates and also transport costs between Asia and Europe, and that could be a cause of increase in the inflation.
Kenny?
Yeah, I think the geopolitical issue is one issue, and if we refer to Peter's question, whether what we need to see to confirm the inflation has slowed it, I will say if we focus on the last week, just the U.S. announced the PCE. Even though the core PCE dropped below 3%, is relatively good and below the market expectation. But if we focus on the core service shelter data, actually is still relatively good, and according to Powell, that data is actually he focusing on. So I think he wants to see not only the overall CPI or PCE data, is in the detail to further confirm they has controlled the inflation. Then they will have more confidence to cutting rates.
I mean, they say that they need to keep rates restrictive for a while longer, but of course you could actually cut rates and they could still be restrictive, couldn't they? So the two could go together. I mean, you could argue that, you could ease rates a bit and they're still quite tight.
Yeah, but if you're cutting rate too early, then will push up the inflation expectation. That it may fail what you have done in the past 1 to 2 years. So they will rather to be prudent to wait for a few months.
And I think, Francis, that's the issue, isn't it? They don't want to be wrong again and start cutting rates only then to see inflation shoot up after they got inflation so badly wrong a couple of years ago. They don't really want to make the same mistake again.
Yeah, definitely. I think central bankers are by nature very cautious people. Yeah. They don't want to make mistakes, and they tend to lag behind the market.
And also, I think in this year also we have a political issue because we will have the president election in November. So if Powell wants to support Joe Biden, he should cut the interest rate earlier. But on the other way, if we prefer Donald Trump, then it to hold on to cut the interest rate later. So that may be another factor we need to concern about.
Do you think these are considerations? I mean, the Fed always says it's totally apolitical. This never thinks about anything like that. But do you think that's true? Do you think there are political considerations that come into play?
I think theoretically they should be independent, but in reality, and I still think that economic issue, inflation data is more important. But political factor, will they concern a little bit? I'm not sure.
What do you think, Francis? Are they? I mean, if Donald Trump wins, he'll probably be threatening to fire Jerome Powell again, won't he? Like he did 4 years ago.
Of course, Jerome Powell would not like to see Donald Trump be the boss again, because he threatened to fire Jerome Powell during his term. And of course, for the Republicans, there are many theories that and some of them are really very crazy. So I think Jerome Powell would like to stay out of politics. He doesn't want to be the target of right-wing Republicans who can say anything.
What do you make of the economic data we've had this week on the Hong Kong economy? We had retail sales showed growth slowing quite sharply there. The economy grew 3.2% last year, but that was less than expected. Although it was an improvement on the previous year where it contracted 3.7%. Are you seeing any signs that things are getting better economically wise in Hong Kong?
Not right now. I think we are just plodding along. We are growing at a very painfully slow pace. And then another indicator is that the decline in property market has not stopped. It's still falling. Property prices are still falling. The only saving grace is that the rental market is holding up, indicating that there are more people renting. That may be because some people are selling their property so that they can rent it. And so we still have not climbed out of the recession caused by the COVID years. And so it will be painfully long recovery, and we really have to bear with it, and we should not get our hopes too high.
Yeah, I agree that the negative wealth effect is hurting Hong Kong economy. But there are another key issue. Maybe, Peter, you will know, Hong Kong people now will go to China shopping and having dinner. But on the other hand, for tourists come to Hong Kong, they are not that type of aggressive shopping like 5 or 10 years ago. So this type of changes is very significant to impact Hong Kong.
I mean, this is a big problem, isn't it? Because Hong Kong people are spending far less here in Hong Kong, and foreigners who are coming here are spending less as well because they're coming on budget packages these days and staying in cheap hotels. And but there seem to be far more local people interested in going to Shenzhen and spending their money there than they are in spending the money in Hong Kong.
Oh, don't worry, we are busy in town. There are many big spenders who are coming.
How do we reverse that? How do we get because do we need tourists? I mean, I suppose we do need them, don't we? But are we ever going to see them in the sort of numbers that we used to see?
I don't think so. I don't. Even now, Hong Kong are treating something like more than 20 million tourists every year. That's really we already reached the upper limit. I don't think our infrastructure can handle something like 50 million tourists a year. That would be far too many.
Kenny,
big spenders are not coming now.
So how do we make ourselves more attractive?
For example, holding more festival or function to attract foreigners to come to Hong Kong, because you can't stop Hong Kong people to shopping in China because it's relatively cheap, and also the government is promoting Greater Bay Area these few years. So that's why we go to China to shopping. So I think it's very difficult. You just can't stop it. So the only way is attract more foreigners to come to Hong Kong.
And what is it that would attract foreigners to Hong Kong? Because we're sort of a bit of an odd city in some ways, aren't we? I mean, the things that used to attract people in the past maybe are not the same things now that are going to attract people in the future.
Yeah,
I agree.
Can get Taylor Swift to come to Hong Kong. Maybe we'll have boost.
Yeah, I agree.
And what about on the mainland? We've had the PMI data now. It was a bit mixed, wasn't it? The National Bureau of Statistics PMI was in contraction, which obviously measures large state-owned enterprises, but the Caixin one is still growing, which is smaller and medium-sized private enterprises. What do you make from the data that we had?
I think that really showcased the need for the government incentive to really boost the market. We've heard the 2 trillion stock market stabilization fund from Bloomberg, but we're still waiting. And the government need to do other things, maybe spend 2 trillion in boosting the economy, something like that. And so without that, I think China will be stuck in low gear and the economic growth will be stuck at below 5%.
Yeah, I think because 2 PMI, the sample size is different, and the official PMI is more broad-based. So personally, I will focus more on the official data, which the manufacturing PMI is below 50. So for myself, I think I agree with Francis is that the government should do more to support the economy to launch more policy to support the economy and the confidence.
Okay, well, thank you both very much indeed for your thoughts this morning. Have a great weekend. You heard there Kenny Wen, who is Head of Investment Strategy at KGI Asia, and Francis Lun, the CEO of GEO Securities.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners. Morning, Toby.
Good morning, Peter.
Now, I think we've had some good news, haven't we, in Australia on the inflation front. Inflation dropping to a 2-year low.
Yeah, very good result, and sort of comes at a time that, if you look outside of Australia, everyone's talking about lower interest rates, whereas here we were thinking that we're quite a bit behind on the inflation fighting front. Noting, of course, that we still have a 4 handle in the CPI, so albeit better, it's still annualised around 4%, well short of the target of the 2 to 3 that the Reserve Bank will want, but it was definitely an improvement. And that was included in the core numbers. You know, the trim mean, which is the sort of RBA measure of the CPI number, was also very good. So that's led to a lot of conversation around, potential moves towards a pivot in monetary policy here in Australia quicker than we'd thought. And that was, obviously then reflected in equity prices moving up quite sharply on Wednesday.
And they're at a new all-time high, I think, weren't they, the Australian markets?
Yeah, it did. I think the ASX 200 got to sort of 76.80, and then, of course, you had the big correction in the US post the FOMC, which is now, and then the bounce back. So we're about 30 points short of that high that was printed on Wednesday. So we're still definitely looking pretty positive.
And what about the economy? You've had the PMI numbers out now, along with lots of others from around Asia. What's that showing?
It's a mixed bag. I think it's pretty consistent with what you'll get outside in some of the other developed economies where, the consumer is still pretty active. I did note, of course, that building permits figures yesterday were well down. So the level of construction in Australia is below what is needed to reach the demand that is there for housing. And that's a structural problem in Australia, and actually can be a bit of a negative for the drive on inflation, because for every 100 houses of demand, Australia's only building 95. We've had a lot of issues in terms of getting construction moving, and that's going to continue to be a drag on inflation, because we have a structural undersupply which keeps pushing prices up, keeps rents high. So on that basis, I think there's a bit of negative, but overall the economy is chugging along pretty well. The consumer is in pretty good shape, although the retail sales figure was weak during the week, earlier in the week, but that was probably a reflection of an overstatement in the previous month. So all in all, not too bad.
Are you seeing any signs in the data of supply chain disruptions because of all these disruptions in the Red Sea, with container ships having to go the long way around Africa? Is that starting to show up at all, either in terms of price pressures or longer delivery times?
I've only heard it anecdotally, and it tends to be suppliers managing expectations as opposed to reality. So there is talk of delays. There is also some industrial disputes. The largest port company, DP World, which runs the largest ports in Australia, having problems with the Maritime Union in terms of wages, and there's been disruption there. So that could also add a factor. And that also lends potentially to a higher inflation environment, which means, the RBA might pour a little bit of cold water on the enthusiasm that came out post the CPI. And we'll have the Reserve Bank meeting, of course, our first one for the year next week.
And of course, this may be an issue for other central banks as well. The big news this week, of course, the Fed leaving interest rates where they were. But it was more the message, wasn't it, that Jerome Powell had, which was that, we'd like to cut, but it's just too early at the moment. We really need to be sure that inflation is going to get down to the target and stay there.
Yeah, to me, it always felt like that was the obvious response from the Fed. And I was quite surprised the market reacted so aggressively against it. But actually, it was pretty much a 24-hour dummy spit from investors because the stocks bounced back pretty quickly. But fairly logical comments from Powell, you would think. Yes, the language has shifted that there'll be no more rate hikes. But, given the need to ensure that you can kill inflation, and we talk a lot about that when you and I speak about inflation expectations, you've got to avoid them being embedded. They're not going to lift it too quickly. And the data, albeit some of the data is a bit softer than expected, like, for instance, Chicago PMI and the various other data shows some softening in the economy. Overall, growth's chugging along pretty well. So I don't think they're in any hurry to loosen policy unless they see a risk that they're going to grind the economy to a halt. And that's just not coming through the numbers. Maybe tonight's payroll number might give some other figure, but even the employment data we're seeing during the week doesn't show – it shows a bit of softness, but it doesn't show, the demand's really, falling off a cliff in the US economy.
So what would it take to convince the Fed that inflation is going to come down to the target and stay there? What do you think it needs to see to convince itself?
I think it probably needs to, and this is a sort of slightly weird way of putting it, but they probably want to see a little bit more degradation in the demand, in aggregate demand in the economy. So they probably want to see that, and probably a bit more unemployment. I don't think they'll ever admit that, but probably a bit more stress in the labour market. That would give them, I wouldn't say confidence, so that would give them assurance that, demand has slowed aggressively enough for, the labour market to start to feel the stress. And that's probably where they'll be convinced that they could probably make some move on policy.
It's amazing, isn't it? The central banks are being very cautious. I suppose that's their nature, but they've been burnt a few times, haven't they? The Fed was badly burned in 2021 and 2022 when they thought inflation was going to be transitory, and then it was much higher, much more persistent than expected. So they are reluctant to cut rates. You've got the Bank of Japan also burnt, but in the opposite direction. They cut rates too They cut rates too quickly, and before wage prices had really had a chance to build up. So these central banks, they sort of really don't want to make the same mistakes again, do they, that they made in recent history?
No. And if you think about wages, it's a very important point. While the labour market's tight, there's pressure on wages, and wages represent one of the key drivers of inflation, both in terms of reality, in terms of actual prices, and in terms of consumer behaviour and demand. So, I think the labour market's a key driver, and, we'll have a look at the payroll numbers tonight. The forecast is for slightly softer jobs growth, but an unemployment rate around 3.7 in the US. If that sort of stays fairly solid, then I think it buys time for the Fed. That would be the one factor that they would probably has been a bit of a conundrum, is the tightness of the labour market, even at a time when they were raising interest rates aggressively. And I think that has been one thing that probably has got most analysts a little bit confused, is why the labour market stayed so tight despite the very aggressive hiking that went on.
And what do you make of the market reaction to this? It seems on Wednesday the investors focused on the bit that said we're not close to easing yet and it's not going to be March. And then last night they focused on the bit that's but they're not going to be hiking either. They've taken the hiking bias out of their statements and sort of rebounded. But where do you think the markets are on this?
Well, as I said to you, I thought it was a bit of a dummy spit, an unnecessary one, because what Powell said was pretty logical and pretty much in line with what the market should have expected. So I think coming back, it sort of it corrected itself. I think the market's position probably where it's vulnerable to correction. So I think the way the market reacted to that suggests that there's a nervousness around these levels, or at least some sensitivity. And, reading a few analysts are saying, look, more chance of a downward correction as a shock than an upward spike from here. And that's mainly because we've pretty much priced in all the good news, the Goldilocks scenario, for want of a better expression. So I think the way which I would analyse the move on a post-FOMC was that there are probably a few people who are ready to take profits, and that suggests that any bad news or any underwhelming news from the market's perspective could lead to a sharper correction than what we're ready. Notwithstanding that the overall trend is still positive. So, our feeling is that the market's probably due a fairly healthy correction at some point. And what's going to trigger that, I don't know. But maybe the signs of that volatility came out with the way in which they reacted to the comments from the Fed governor.
Also, maybe there's a trigger again in the regional banks. We've suddenly seen a slide again, haven't we, in the regional bank index, and one of them, the New York Community Bank Core, it slumped 11% overnight, 40% the previous day, because of these rising sort of loan losses linked to sort of office buildings. So maybe that's the warning sign.
Yeah, that might be. There'll be a few canaries in the coal mine, as they say, to watch out for. But overall, if you have a look at corporate earnings on the whole, let's say take the bank sector and the regional bank sector out, I was reading about 30% of companies had reported, and there's a 79% beat on earnings. There's obviously been some underwhelming ones, but generally speaking, the corporate sector's still producing pretty good profit results. Mm-hmm. So the market's not wrong in terms of its, the way in which, the economy's going. But, yeah, I guess we're more vulnerable to negative news right now because of where share prices are. So I guess that's the way in which I analyse the reaction to the Fed.
And these big tech stocks, they're still delivering, aren't they? Amazon reported better than expected results. Meta certainly did. They seem to still, despite their extended sort of valuations, they're still coming out with the goods. Yep.
Apple's results weren't too bad. They got some growth, but they missed on sales data, so they came off a little bit. But yeah, overall, as I said, I think the mega stocks, the mega cap stocks, lofty in terms of valuations, but the results are pretty good. So, I don't think necessarily investors want to get out of them, but I would say that they're more vulnerable to wanting to take some profit.
And what is noticeable is the ones that are exposed to China, where they generate a significant amount of revenues in China, like Tesla, like Apple. They are suffering, aren't they?
Yeah, and you're looking at the China data, the PMIs this week. The PMI was slightly expansionary on the Caxton yesterday, but it's still a little bit anemic for one of not coming out at a rate of knots. And I think that's going to continue to be a bit of a theme to watch for. Is can China get some velocity into its growth in 2024?
It's depressing being an investor into China. Unlike Australia and the US, where you're at all-time highs, we're a long, long, long way from those highs.
Well, there's swings and roundabouts, that always got to be mindful that, not everyone's at the top every day.
Well, thanks very much, Toby, and have a great weekend. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and David Friedland, Managing Director of Asia Pacific at Interactive Brokers. And providing a view on mainland China will be China specialist and author Mark O'Neill. Have a great weekend.
Money Talk